Hello friends, this is Martin from Secret, the channel for learning about trading and investing. Welcome to Markets Tomorrow, the daily market analysis show where we look at what happened in the market during the previous day and how we can look for a better trade plan for the next day. So we had a market that was fighting the gap resistance, right? But it was a green close for the Nifty, and market is closed higher for the last 2 days after the big fall that happened. But it's in the mid of window gap basically, right? In technical terms. So let's go in and see what exactly happened. So as usual, our pre-market analysis for March 2nd, Wednesday 2022 will be based on all of these parameters that you have on the screen on the left side. We'll be looking at them on the charts, and we would have additional data analysis on additional parameters that you see on the right side. We will also have some actionables and then we'll wrap up, right? So look at so obviously today is a holiday. March 1st is a holiday. So this is the chart for the Feb 28th that you're seeing, the last trading day. Look at this wide range bullish candle that you see in the Nifty, but the gaps still remain open. Gaps are very powerful. That's why this is repeatedly said. Gaps forming resistance or support are very, very powerful in technical analysis. Here on the right side, what you see in BANKNIFTY is also a green candle is what you see, but it's closed below the previous day's high, right? The previous candle also is not closed above the above the previous candle high. So there is some kind of weakness or consolidation that you can see in the short term on the daily candles on the Bank Nifty, but that's exactly what happened. That's so 135 points gained in the Nifty. That's near to 1%, 0.81%. Right? It's a bullish white range candle. You can clearly see that. All right. So it's the second day of the bounce up after the big 5% fall that happened, and you can see that there is a new swing low that has happened on the when the market fall down big. It is a new swing low. This is a previous swing low, and now it's a new swing low. So it's a trend line channel that we talked about in the last video also, right? It's slowly trending down, making low high pattern. Here also slowly trending within a channel, trend line channel. If you draw a trend line channel, the highs and lows slowly trending down. So it's a M pattern also. Look at this, Bank Nifty. It's an M pattern that you can clearly see, and on Nifty also you can see it's a M pattern, with a neckline somewhere down at 15,950 levels that's getting formed. So that's what Nifty is. Bank Nifty actually, contrary to what Nifty did, 0.62% loss is what happened, right? 225 from the previous close. There is some weakness as I showed you earlier. Double top is there, the Bank Nifty also, and trend line channel down sliding is happening. Right? Intraday, if you look, this is what happened, right? We had a big gap down and then it trended upside. Right here also, here we had a big in the sense, what percentage was that? It's like 1.75% of gap down happened, and then 2.75% of recovery happened. Bank Nifty 2% of gap down happened, but the recovery did not complete more than that. That's why it closed at, right? Bank Nifty could not go trending up as much with as much force as it had done for the Nifty. Nifty trended up after the dip. That's the price action in the intraday. Bullish bands, if you see, you can clearly see that the volatility is expanding on the upside and the downside, and the price has moved along the lower bands, showing bearish trend, and the expansion definitely shows in the high volatility that we see. Bank Nifty also same. It's an expansion that has happened both. Expansion means volatility. The distance from the median to the bands, higher and lower is more, means it is expected to be very volatile. That's exactly what you are seeing. Now, if the price is moving along the lower band towards the downside breakdown, so it clearly indicates bearishness on the short term for both indices. Look at the support resistance. What is marked here in a box is the gap from the previous candle and the big gap down that happened. So it is in the mid of that basically, right? 2 days of movement happened, although it closed higher. It is very much in the lower portion of the big gap. Here also you can see it is much below the gap. It does not even hit the case of Bank Nifty. So this gap in both indices would be a major hurdle to overcome before we can even think of some up move, right? So look at the levels, making note of the levels. So the resistance immediate can be seen at 16,700, 16,750, that level, although it is closed above that. Only the next day will say whether that the level is hold, so I put it as a resistance. Then 16,800 to 16,900, Fibonacci 38 would be the major resistance upside. Then 17,000 would be the resistance above that, and 17,200, 300 that band, then 17,350, 400 that band, and then above that 17,500, which is Fibonacci 23 retracement levels. On the downside, the support is 16,550 to 16,650, that's all, and then below that we have the majors, Fib 30, 16,350 to 16,450 major support, and below that you have the gap support. There is a long gap support that is seen as 16,150, 200, that range. Then below that you have the 5950, which is a Fibonacci 61. That is very crucial. So that's a support resistance on the Nifty. Bank Nifty also, the major resistance where it is hovering around right now is 36,300. It is 800, that band, wide band, and Fibonacci 38 also lies in between that. Then the entire gap zone is a resistance. Wherever this box is there, the entire gap zones, right, is a resistance. So resistance next, it comprises of Bank Nifty 6,900, 37,000, 37,500, then above that 37,800, then above that 38,000, then above that 38,500. So all resistance on the upside. Downside, you have support of 35,000 to 35,300, that level. Then 30 Fibonacci 50 is also there, which is coming at 35,000 kind of levels. That's a support down, and then 34,750 level is also. So the Fibonacci 50, the 35,000 level is also happened to be the previous swing low, right? And then you have the very crucial Fibonacci 61 at 34,000 nearby levels, which also happened to be a previous swing low also. So this is a very crucial. 34,000 is a crucial level for the Bank Nifty, and breaking of 16,200 and 5950 both are very crucial on the downside for the Nifty, right? Similarly, on the upside, a close above the 17,050 kind of 17,000 levels is very crucial because it is a trendline channel break as well as the gap break, right? Similarly here, 37,500 above close would be good for the upside for the Bank Nifty. Look at the momentum and divergence. You can see that it's got back to the sideways also. There is also the Nifty, and Bank Nifty also, it has gone back and from the bearish zones into the sideways zone. So medium term, that's weekly charts. If you see, it's already in the sideways and maintains that, right? So the momentum has picked up, and then it has at least not gone deep into the bearish zones. Exactly when the bounce happened from the low, the momentum also put up. There are no divergences in as of now. Trend remains to be bearish. Momentum is sideways, shift has happened, but trend remains to be bearish on both indices. Medium term, it is bearish actually. Short term also it is bearish. Bear zones, and the not so good part is that the trend strength indicator is showing that there is strength, there is rising up, right? So bearishness is rising up on both the indices on the short term, right? Now, yeah, so this is the horrible part, right? The India VIX is shooting up to and closed at 28 after another spike of 7%. So remember that we had up to 50% of a move that happened last week. Now after that it cooled off, and then the spike is not stopping. It seems to be forming a very a range above the 25 to 30 kind of level. So it's extreme volatility. Implied volatility is 99.6, and implied volatility percentage is 99.6, and implied volatility is 27. So it's all very high volatile environment. This is what's happening. Obviously, when bad news, war news, and all that happens, this comes and then goes. Right? So when it reverts back to the downside, you never know. Right? So this is not a bear market; it's a bull market. It's a correction. It's an event-based thing that is happening here. So it could revert as soon as the event gets cooled off, right? But trading in this environment is extremely tough, and you have to be extremely cautious, especially if you're playing options without knowing it fully. Open interest analysis for the March 3rd, Thursday, this coming Thursday, weekly expiry. You can see some unwinding on the Bank Nifty put side, and also Nifty is not giving any clues, but bearishness is standing out. So 16,000, 7,500. It's 1,500 points. This range is what options sellers are seeing from the put and the call side, right? So the supports remained, that wide apart between 16 and 17,500. And the second highest put trading is seen at 15,000. That's too far away. And 18,000 also is too far away, right? So that is having a range of 3,000 points. So that's the kind of volatility and the fear that is there in the market, where option sellers are taking the widest possible range, because then nobody is sure of how far the market may move in this environment, right? So there is some kind of very close to bullishness is there in 0.83 put call ratio on the Nifty and the Bank Nifty. Bank Nifty also is 0.8. It's not bullish, but going towards that, you can say put call ratio. Future open interest is showing long build up in Nifty and short build up in the Bank Nifty. Bank Nifty levels you see 35 and 38. Here also the volatility has caught up, right? The range has come to 3,000 points. Earlier it used to be 1,000 points when before the breakdown, big 5% or 7% gap down that happened, last Thursday. So the range volatility is increases. So the option sellers are putting the sell, the writing of the calls and the puts and the calls in a wider range. 34,000 and 39,000 also has got the second level of put has put in the Fyers right. That's the ranges for the weekly expiry. Let's move on, and the heat map shows that there is some green lines has done well. There are some heavyweights, IT stocks also done well. Right, steel metals are doing extremely well. All are good except auto is having some issues. Chemicals and pharma also is not showing red on the sector-wise heat map. If you see index heavyweight, some indecisiveness is there after the gap down that happened on Hdfc Bank. Momentum managed to climb back to sideways. Right? Overall trend is bearish, and that gap that has formed has to get filled now before we can say anything on this Hdfc. Probably it's maybe time to buy it cheap, right? Such good stocks, quality stocks, which are major contributors to the index. Right? You may never get this kind of prices if the market manage to go back after the event cools off, right? Hdfc, if you see, you can just cut off. So Hdfc, you can see that it has slipped off from the major support zone where it is, and it's kind of consolidating. A red is what formed the previous day. Lions is showing a green. Big up move happened. We have seen at the heat map also. So it's a cup and handle formation. It is in the sideways momentum. Nifty is also consolidating if the green close, and momentum is sideways. So the two big fall off in the Hdfc and the HDFC Bank have now come back in the sideways. Lions heading up, showing some greenery well within the channel, cup and handle. Nifty has green close because IT did well. TCS also green close. After that big 2-3 multiple runaway gap downs that happened during the last several days, now there seems to be moving up in green close. Kodak Bank is also showing green, it's trying to move up to the resistance. There's sideways momentum. ICICI Bank also green, shown the support is taken seriously by the ICICI Bank and climbing up ahead. So the other day we had seen that the support zone for TCS and ICICI Bank is crucial, right? Exactly, that's what happened. It took the support seriously and then respected it and then moved up. ICICI also did the same. It was at the crucial support zone. It just slipped down from that, but it climbed back to that. Sector-wise performance, if you see, IT moved up 1%, climbed back to the sideways one. So metal 5%. Oh, this is mistake. It's not 5% down. Metal did a big comeback and it's 5% up, and the momentum is in the sideways, rising towards this bullish zones. Auto is only sector. It closed red. Auto is only sector that closed red the other day. 0.69 major sector. It's been bearish. Momentum is still in the bearish, resisting in the 40 RSI. So the pharma is closed flat 0.22, right? So auto and pharma are showing some resistance or some bearishness left in the last trading day. FMCG closed green 0.6, reality 0.6, also sideways momentum. FMCG and reality and IT and metal and pharma are showing sideways momentum except auto bearish, right? So there was some up across the sector that happened, but auto and pharma are having some troubles left. But sideways is not enough for us to have a top-down approach of stock picking, so we'll have to wait. Institutional selling continues. Another 4,000 crores of selling happened by the Fyers the other day, and DIs are equally buying, and that is the only reason why the market is staying. Look at the last 2 days in the March, in the last 2 days of the February, right? Big 4,000 crores of buying had happened from the domestic institution, right? So retailers and mutual funds keep buying, and that's the only reason that we don't have a big crash. Otherwise, would have long be gone. And because affairs continue to sell at the same pace. Dollar is kind of consolidating, but it's increased and gaining momentum. Currency pair also attempted to move above 75, but facing some resistance at the major resistance zone, and it is kind of consolidating and showing a red. And so basically, we had kind of gained little momentum, and as compared to the dollar, the other last day of trading, you can say, right? Crude is again showing green and moving above the 97 kind of levels is what it is. Crazy levels, and it had already touched 100 other day. And there was a gravestone doji pattern which gave the indication that probably it may cool off a little bit before it further moves up. Looks like the momentum is crazy, and it is once again heading towards the 100 kind of levels. Gold showing green once again. There was big resistance that is seen at this 1914 kind of 1917 level, which is very crucial resistance zone. So it had burst out of that and then fallen back into it. So whether we'll get a green close above this would clearly indicate whether gold is going to really break out this time or not. But remember that momentum is very good, trend is very good, and price is clearly trying to take out this major resistance zone. So keep a watch on that. Gold may be a good hedge at this point when none of the sectors or equity markets or bonds, when a lot of uncertainty, all this is there, gold would act as a good hedge and is likely to move if at all there is a major crash that's going to happen, right? So keep a close watch on the gold. Gold can be bought either by the sovereign gold bond issued by the RBI, or it can be bought as gold bees issued by Nippon and several other companies, or gold mutual funds. There are different ways of investing in gold. If you're not seeing the video related to that, check out that in the playlist. Global markets, if you see, you can see that there is a green and there is a bounce that happened from the major support on the Dow Jones, and it seems to be a little hesitant to further move because there is a indices candle is where it ended up, but the momentum has just managed to climb back from the bearish zones to the bullish zones. Nasdaq is also showing some green, and you'll have to see that next day also, right? So it's just just trying to move up definitely. Just S&P 500 also has taken this support very seriously and then bounced it exactly from there and then well within the channel. So whether this momentum would sustain, right? This sideways momentum would remain, or would it break down once more, is what we'll have to keep a close watch on this. So pre-market is where we'll have to check how the US market performed. If there is a major big moves that happen in any of this, then definitely our market will also be that. But if it is normal neutral kind of moves that happen, small moves that happen, then it would be not impacting that much. Anyway, it will be reflecting the SGX the next day most likely. So US market survived the crash from the major support zones, you can say, and that's where it is. Two actionables, Birla cable weekly chart is what you're seeing. It's kind of a rounding pattern, and there is good score for till the next resistance of 181. It can give a good swing trade, and if you trail that and then can even go further up, right? Momentum is great, volumes are good, trend is also bullish. Dr. Reddy Labs is a bearish bet. The weekly chart is what you are seeing. The cup and handle kind of breakout, it failed and it has broken down from the main neckline. So there's no major support seen down here, so it will give a very good swing. And the momentum is broken down to bearish zones, trend is in bearish zone, so it's a good, probably a good, short selling for a swing short sell for Dr. Reddy Labs, and a long bet on the Burla cable. Right? Remember, these are not recommendations, but for educational purpose, you can analyze and understand why it is set long and why is it short. Right? That will make you pick your own stocks. On the same principles. But wrap up, it's mild bearishness, although there's a green up move and closer high, everything is there, right? Still, mild bearishness to sideways is the view that I have. Reasons: sideways momentum, bearish trend remaining there, Bollinger Bands breakdown, right? Below the median close. So, 2 days up move has happened, but banks are showing weakness. Last 2 days also, it did not close above the previous day's high. Every day, it was struggling to close above the previous day. So, the pullback or the up move, there's no diagonal strength in the banks. That's a worry. Banks are the major constituents of the market, and big window gap resistance is seen, right, in both indices, and it's in the mid of that. Actually, Bank Nifty is not even in the mid of that; it's below that. So that has to be, covered, and double top formation is there. Neckline is not reached in the Bank Nifty, but Nifty may be close by. So whether it will break that neckline is what we have to closely watch. So this bearishness all around. So you just can't be bullish at this stage. The charts are also clearly saying that, and we've already seen that. So there is war talks, there is peace talks, all this is happening. So markets can be very jittery on the upside and downside both, as indicated by the Bollinger Bands. Can be extremely volatile and it's very tough. Even for professionals, it's very difficult to trade in a very short time, right? Using options from cash or whatever, right? It's very difficult. So already is crazy, 28% up, 28 plus is the normal that is seen is 15 to 10, 10 to 15, or 15 to 20 is max, right? Anything beyond that, it's very difficult. If has continued selling, right, it's remained the reason they have been doing this from the last April. There's selling and selling only, right? So it's non-stop and continuous, right? The only thing is the mutual funds keeps adding up funds to it. Positive factors is that market positive factors as of now there is no, fundamentally also there is not enough of positive factors falling on, but market is showing some strength. It's not ready to break down. That is the only positive factor, right? It's just climbing back to the sideways whenever it falls in the bearish. It's not staying in the bearish zones with the momentum, with respect to the momentum, price action, and whatever. It always get bored and then tries to climb back. So that strength is there in the market. So that's only positive thing. Stay away if you are not a very professional trader, unless you fix schools after 20 and below, right? So yeah, gold I talked about. It's a good hedge. You can buy. If you have long-term investments, you can hedge them with an equal amount of gold that can be purchased. And picking up the SIP mode, long-term quality stock also, this may be the right time to get them at a low price, buy the dips, right? Maybe an idea, but in SIP, not in one shot, right? If the market corrects further, another 5% buy again, a small amount. Then if again 5% buy. So that's the way we have to invest and not at one shot, right? Because we never know this is bottom or not, right? Then further 5%, 10% fall also can happen, right? So also upside, also don't wait for that, market to fall a little more, which sometimes may not happen. This may be the bottom. So it's very difficult to catch the top and the bottom. So that's, so if you're trading in options, if at all you're forced to trade or you have to trade, then trade with hedge positions, risk defined positions, neutral strategies, delta neutral strategies, risk defined strategies where you know what exactly you lose max, right? Instead of risking the entire capital or a large portion of the capital, you can get wiped out beyond imaginations when the market is highly volatile. So be careful, be cautious, and then, right, stay tight if you are a long-term investor, right? Sit tight, right? So that's what my view is. Mild bearishness still there. and the sideways kind of movement is there unless the gap is filled, that would remain, that view would remain in the short term. Right? Window gap is something I'll watch out for. So if it helps you to frame your own view, then consider hitting the like button and share it max. We have very few subscriptions, and it means a lot to have more subscriptions at this point in time to help us motivate to keep doing this. Thank you so much. Happy trading and happy learning. Bye.